Hi and welcome to this emergency investor hour edition of our podcast. Today the stock markets, crashed as they did, and we all saw how they fell right from get-go. And this actually is sort of a manifestation of uh, several problems that were building up and which the markets were ignoring. But starting this past Monday, they've taken hold and the markets have done what they've done. But of course, that's the past. And like we try and do on the investor hour, we try and sort of figure out what do we do next and how do we find profitable opportunities in all the euphoria or in all the fear and the gloom and doom like today. So before we proceed, a slight change today. My name is Rahul, and my co-host for the Investor Hour, Sarit, is not on the show today. He's traveling. He's gone for a holiday to God's own country, that's Kerala, far away from all the noise and all the crashes in the stock market. Lucky him. But but to sort of move ahead from that, the moment the markets fell this morning, and I started sort of seeing a little bit of the chatter that was around on the WhatsApp or the news channels, I immediately reached out to Vijay Bhambwani and requested him if he could make time today to record this episode of the Investor Hour. And the reason I did that is for twofold. One, of course, is that in times like these, in uncertain times, there are, innumerable theories that are going around on what could happen next. And I believe the fear is going to feed on itself, rightfully or wrongfully. And therefore, it is very, very important to listen to a sane voice. The second reason I reached out to Vijay was that usually when markets fall, a value investor like Warren Buffett, who the other day gave an interview to CNBC, I think a couple of days back, and he was very clear. He said the markets have fallen and we are bigger buyers today than we were yesterday. So a value investor is naturally tends to get very excited about these times because he gets to buy the stocks he likes for cheap. Having said that, I thought it may be better to get Vijay's perspective because Vijay, who I call India's number one trader, and many agree with me, is someone who has a pulse on the market where he analyzes the market firstly like no one else. And I think he straddles both the worlds where he's looking both for signals on the screen, which can tell him what can happen in the near term. And of course, he's looking at a lot of the data and the information that he's getting from his own reading and his own research and also from his network from, across, which is a little more fundamental and which tells him where things could be headed in future. So, and I think that kind of a view is very, very important today as against a view which is just buy and hold view today. So I reached out to Vijay, he agreed, and he's on the call right now. So Vijay, thank you very much for doing this at short notice and welcome to yet another issue of the Investor Hour.
Hey, thanks, Rahul. It's always my pleasure and privilege to address Equitymaster subscribers. And I'm very excited about the podcast today. So let's get this going.
Yes, let's jump straight into it. So I just pulled up a couple of screens on the Bloomberg website, and okay, I'm going to step back. So I'm going to cover broadly four things with you today. Mm-hmm. I'm going to talk stock markets.
Okay.
I'm going to talk commodities.
Okay.
I'm going to talk bullion, and I'm also going to talk currency.
All right.
Right?
All right.
So that we get a holistic perspective of where we are. So starting with stocks. So I just pulled up, like I was saying, the Bloomberg screen and showed that most, I think, global markets be it the US, be it Hong Kong, I think Nikkei, they're all down roughly 10% over the last 1 month, with the bulk of the fall having come in the last 3-4 days, and they're still falling. How are you reading this situation? What do you think triggered it? What do you think the markets were ignoring and, they took a knockover? And where do you think it's headed? So that's as broad a question as someone could have thrown at you at this point in time.
Sure, Rahul. Rahul, in my videos on Equitymaster, I've basically been repeatedly laying forth the hypothesis. It's not just a hypothesis, actually a game plan, an established game plan called the U.S. presidential election cycle. And in the run-up to the U.S. presidential election, magic actually occurs. Your economic data suddenly turns positive, your employment figures are gravy dressed, the dollar becomes stronger, and corporate profits actually start to firm up, which almost invariably means that your stock market goes up. And what happens in the U.S. happens the world over, because the largest financial market or the capital market in the world is simply the United States. What was happening across Asia was there was an huge amount of bravado in the sentiments. We all knew there were some crevices, some cracks, some weaknesses. For example, in my videos, I've talked about currency weakness, that India will have to fight a three-pronged war. This video I recorded for Equitymaster on 24th of September last year. And I said how countries will basically want to devalue their currencies so as to compete in the international export markets. Now, when you devalue your currency, you might get more competence in exports, but any and everything that you import becomes more expensive, which is why this phenomena is called imported inflation. So if you actually were to monitor the imported inflation across Asia, you would realize that Asians were actually having lesser and lesser amount of money in household savings because their cost of living was going up. Obviously, when your kitchen bill is going up, you're not buying stocks. The other aspect, and I think this will interest you a lot, is I've been monitoring some of these high-profile auction houses, Christie's, Sotheby's, and the likes. You'll be surprised at what astronomical prices the super rich are paying for vintage and works of arts and old wines, etc., which basically tells you that money, or at least the big money, is extremely scared. And it does not want to go into financial assets, which is why it's bidding up these works of arts and collectibles and mementos and vintage cars, etc., at prices that are unbelievable. So this was basically telling me that the equity markets are treading on very, very thin ice.
Yeah, so that's a very good sort of perspective. And I think when yields are what they are, if you look at the US, it's just over 1%. So, you're far better off probably trying to figure out opportunities in other asset classes, I guess. That's what it has done. So I guess the coronavirus was the final sort of trigger to bring sanity back to the stock markets in some senses, because all this was already happening, but the markets kept ignoring it and kept moving it. Like you said, false bravado. But now with the virus here and now, you think that the pain is here to stay?
Rahul, no financial market trend is one straight line. It's more like a jagged, mountainous kind of a surface. So sure enough, there are so many of these theories, especially prevalent with statisticians. After X number of continuous days of declines, there is a pullback, and the pullback has been Y percentage, etc., which is all true. Mm-hmm. But the point is, are the mountain peaks progressively lower or is there a peak which is higher than the previous peak? To a technical analyst, that's an all-important factor. As long as the peaks are getting lower, the market is trying to tell me, hey, I'm going to find equilibrium at lower prices. And that's something that has been happening at least since the last fortnight, if not longer. The numbers that I have been putting out on the Equitymaster Telegram channel, the post-market synopsis of the MWPL, the market-wide position limits, the traded turnover, and yesterday I put out another interesting metric of the open interest. So that basically tells me that there is increasing pressure coming in from sellers, and this is big money selling. I'm not talking of retail guys. It's the big guys and the institutions who move the needles and gauges in the markets. The small guy barely makes a difference, and the big guys have been getting out.
Yeah. And I think this is the point you made in the Equitymaster editorial meeting as well, quite some time back, that you basically said that it's going to trend lower, and then I think the additional trigger that turned out was this whole coronavirus thing, where it then just suddenly sort of collapsed, if you will. Were you surprised by the extent of the sell-off? I knew you were expecting a sell-off, but were you surprised by the extent of the sell-off?
Yes, Rahul, admittedly, yes. I would be lying if I said the magnitude did not surprise me. Although I, on this Monday's editorial conference, said I would be pleasantly surprised if the Nifty or the Bank Nifty even rose to the opening level of Monday, which means right up to Friday, the market is expected to go down. But to be very, very honest with you, Rahul, today's viciousness, the amplitude of the decline has caught me on the wrong foot. I was not expecting a decline this big.
So how are you reading, talking specifically, even more specifically about the Indian markets, where do you think we are headed now?
Rahul, normally when everything is going okay, it's the dog that wags the tail. It's when situation gets out of hand and out of whack that the tail starts to wag the dog. I believe now the tail will start to wag the dog. I'll talk about a fundamentally trading perspective reason, and the other I'll come to later. The fundamental trading aspect is that people over leverage, and the contract sizes are so big, and some of these contracts in terms of capitalization of the contract have actually hit almost 1 million rupees. And the margins have been increased. The mark-to-markets have been made stringent. So in times of distress, you basically see people actually selling their delivery holdings to be able to meet their mark-to-market commitments, which is very surprising, which is why I said the tail is wagging the dog. So here in this case, in a decline like this, and this was something that I discussed in that meeting itself, I said to fulfill their mark-to-market commitments, I fear traders will do the ultimate foolish act of selling their deliveries to fund their mark-to-market losses. If you've been funding your mark-to-market losses by selling deliveries, what do you do today? Your broker will, as it is, square off your long positions because now you've run out of money, which means now the spiral will actually become a lot more choppier, a lot more volatile. Like I said, I do believe that the decline will not be like a straight line, like a child's foot ruler. There will be jagged pieces of spikes here and there. But I think the tone and tenor is actually set. I would expect lower peaks, and rallies would get sold into. Now, the concept of overhead supply will come in. Traders who are gumptious enough to hold on to their long positions, dig their heels into the ground and say, I'm going to fund my position, but I will not book a loss. These guys, when they see prices coming to levels where the losses have become acceptable, or maybe they are breaking even, they will start to exit. So the market
selling pressure at higher levels.
Yeah. So the market, basically the upside will now get capped. And this will get capped for quite a while. I'm not saying in number of years. For us traders, tomorrow is long term.
Yep.
Right? So for a couple of weeks at least, if not a couple of months, the peaks are in place.
Yep. Yep.
And the other reason which I talked about, I'm sorry, you were saying?
No, please go ahead.
The other reason I was talking about was if you ask traders since 2018 or 19, as early as late 2017, the trading community has been saying ye 5 share ka teji hai. The rally is a 5-stock rally. It's the headline index heavyweight stocks that were rallying. And what the traders call side counters. Side counters mean stocks that don't really get benchmarked into any indices. The mid caps, the small caps, the micro caps, etc. Those stocks were hemorrhaging.
Yep.
So what you were basically seeing was, if the market was a horse, the horse was being forced to drink water. And now the horse is letting out the water.
Okay.
And this process is going to be around for a little time.
Yeah. So I don't want to put you on the spot, but in your study of your charts and all, as things stand today, and of course we understand things can change tomorrow, tonight, Monday, where is the floor for this market? Or which is the floor that we should watch out for, that if it goes beyond that, then there's all mayhem?
Rahul, in the September video that I mentioned a while ago, I said India will have to fight a 3-pronged war. One is reduce taxes, which the finance minister did in September itself. And now a slight more relief in the budget. The second was reducing interest rates, which the RBI Monetary Policy Committee has done in 2 installments. The third is the currency war. I expect the USD INR to go up. And by up, I'm talking of 73, maybe even 73.5 and above. If the USD INR goes up to that much, possibly the 10,500, give or take a few percentage points, of course. This market is not laser precise for the simple reason that human emotions come into the picture. If the USD INR does not go beyond 73, 73.5 by end of March or April, I think 10,500, give or take 500 points here and there on the Nifty, should hold. If you go beyond that, and that's when the hurricane of imported inflation will really blow our roofs off. Because everything that is imported, and remember, India is a net import-dependent country. We are not net exporters. We are net importers. In that case, the imported inflation will possibly drive the markets somewhat lower. So I'm hinging my computation on my mathematical models purely on the USD INR, or mainly on the USD INR as of now.
So there's a lot to unpack over here.
I think so.
You're saying that if the rupee does not depreciate, which means we remain uncompetitive in the global markets, the market could fall, the NSE, the Nifty could fall another 600-700 points all the way down to 10,500. Is that what you said?
That's right. What I'm saying is, if the USD INR, which means the United States dollar versus the INR, or very simply saying, if the rupee does not depreciate beyond 73 to 73.5, the floor might be around 10,500, give or take a few hundred points.
Perfect. And if they do depreciate, you're saying after that we'll be importing inflation, which will have its own repercussions.
Exactly, Rahul. Everything from your mobile phone to your milk, eggs, curds, vegetables, everything will suddenly start getting more expensive.
So we are in like a catch-22 right now, right?
Absolutely, Rahul. Let's not forget, a couple of days ago, I posted an update in our Telegram channel about the M3 money supply. The M3 money supply is now hit its lowest after October 2018. Now, M3 money supply is the broad supply of money. It includes everything. The coins and currency notes that you have in your pocket, your checks that are in clearing or amounts that are lying absolute clear balance in your bank accounts, your outstanding bills receivable, your negotiable instruments, your corporate deposits, your bonds, etc., everything. The M3 money supply is now at October 2018 levels, which means money is actually going under the mattresses and under the pillows, where people are saying, I'll rather keep my money in my flush tank, but I will not spend it, or I will not lend it, I will not conduct business with it, which means you're in for another shock. And I've always maintained that reducing interest rates is actually incentivizing the borrower and punishing the saver. And when you reduce interest rates, there will come a time when the HNIs, the guys who really move the needles and gauges in the markets, will get pissed off, will stop writing out checks, and your markets will hemorrhage.
Wow, that's a tough scenario ahead for the markets. But this is, like you said, for a trader, long term could be even one day or a few weeks. What do you think will sort of help turn around this sentiment in the market? What could be the trigger for us to put this in the past and sort of return to a more benign, if not relatively bullish or positive environment?
Rahul, mercifully, the market is not like an aircraft. If you switch the engines off the aircraft mid-air, the only time it will stop falling is after it hits the ground. The markets are not going to come down to zero. So I don't see the Nifty coming down to 3,000. It'll come down sharply maybe, or over a prolonged period of time maybe, but it has to find a floor. At this point in time, my visibility is 10,000 to 10,500, give or take. Like I said, I'll still need to watch the screen signals as they unfold in front of my eyes. But what will sort of give us stability is, number one, like I said, the USD INR. I belong to that school of thought which believes that the BSE Sensex, the Nifty 50 and the Bank Nifty are not, I repeat, not the barometer of the economy. Shankar Sharma says the Nifty 50 and the BSE Sensex concerns people between cuff parade to whirly sea face. I agree. But what is that financial instrument which concerns 100% of Indians, men, women, and children? The currency, the rupee. Now, this is my theory. I'm coming back to myself. Now, this is something that concerns all Indians, men, women, and children. This is the barometer of the economy for me. If this currency is going to depreciate from here significantly, then your Sensex can do anything it wants. I think we are getting poorer.
Yeah. Okay. Interesting. So now I know that you can't talk stock specific at all, but I'm going to still ask you. So given the outlook you have for the markets, so I guess there are shorting opportunities out there.
Yes, Rahul, I think so. I think this market, maybe it'll stabilize and spike up a bit, but then you're going to see a huge amount of selling coming in into waves. What has happened is that only the savvy money has managed to get out. The retail or maybe even a somewhat experienced trader has been caught off guard for the simple reason that the markets have opened gap down today and yesterday. We didn't really get people off the hook by allowing them an easy exit. These are the guys who will provide the next wave of selling. So there will be opportunities. I agree completely.
So I know we can't talk stocks, but any particular sector that's your favorite for shorting? I guess I can guess the answer, but I'm going to ask you.
Rahul, anything that's inefficient, anything that's underperforming, anything that's lagging will get punished, because a bear market is very unforgiving. A bull market forgives all mistakes. A bear market punishes you for even a small mistake. And I think you know where I'm going to be coming from, but I think PSU banks.
Right, I knew that, yeah.
Yeah, so my logic is pretty simple, and this is something I've not been saying now, but since 2011, that your net interest margins are more or less 3%. All right?
Mm-hmm.
Your NPAs in some cases have crossed 20 or even 25%.
Mm-hmm.
So my very simplistic Dehati brain calculation tells me that these banks are not going to make money for at least half a decade.
Yeah.
So how are they going to pay the fixed depositor whose money is due in the next 2, 3, 4 years?
Go to the government and get recapitalized.
That is one, but I don't think that's
give our money
enough.
back to us. Give our money back to us.
It's not going to be enough, Rahul. The recapitalization amounts are actually maybe just a morsel here and there. The amounts in fixed deposits due for redemption is much bigger. So what I'm coming to is that these banks need to take fresh FDs to keep repaying the old FDs.
Mm-hmm.
And we've very recently seen the M3 money supply shrink, which means people are putting fewer FDs.
Mm-hmm.
Obviously, if you cut my interest rate, I don't want to put in more FDs.
That's correct.
So now suddenly you have a bank which is saying, look, I'm not getting fresh FDs, so I can't possibly be able to pay the old FD guys as easily as I was paying earlier. Now let's raise some money, which means more liability, more interest outgo, and lesser profits for these banks. I'm hammering them.
Got it. On that note, let's move to commodities. Now, this is something that I think if there's anything you know better in the stock market is commodities. And I think your favorite, sort of commodities, from what I can see from, what you tell the subscribers, you're on top usually with the natural gas trade and the crude oil trade, I think. Tell us what's happening in commodities, because as we've seen the stock market sell off, we've also seen a very big sell-off that has happened in crude oil. I know whenever I meet you, you tell me about certain dates in the year when, natural gas moves one way or the other. And you're just able to trade them so well. Now, in the context of the environment that we are in today, which is full of fear, we don't know what's going to happen tomorrow, how are you looking at, a couple of your favorite commodities, and what should our listeners sort of take away from that in terms of an impact on the economy, or maybe even a trading opportunity that may exist in the near term?
Rahul, a lot of guys have basically called out a decline in hard asset prices. By hard assets, I don't only mean industrial or precious metals, but even natural gas and crude oil are classified as hard assets because stored properly, they almost have a perpetual life. So a lot of people alongside me have been talking about declining commodity prices. Of course, there's a counter school of thought which says commodity bull markets are around the corner and the markets will prove who's right or wrong. But in my humble opinion, the one thing that I'm seeing almost the entire market miss out on is a very critical aspect of the supply and demand dynamics. In the stock market, your supply is constant. The paid-up capital of a company does not change. It's a simple matter of stimulating demand by putting out buy recommendations in social media, mainstream media, and research reports, etc., direct communication to clients, and stock prices go up. In the commodity market, both supply and demand are flexible. So if Hindalco was to see aluminium prices go through the roof, all they need to do is tell the mining engineer, go out and dig some more, let's take out 10 more tons of aluminium and sell it, because I don't think this price we'll get again. While the metrics of the stock market tells you that thanks to the coronavirus, the Chinese now, by the way, consume 1/5 of the entire global production of industrial metals. And the Chinese are not buying as much as they did last year. We figured that one out for ourselves. Everybody's figured that out for themselves. I'm drawing your attention to another aspect of it. Start from Latin America. Now, most of these countries that I'm mentioning would fall in the category of emerging markets, or EMs as we call them. Ecuador, Puerto Rico, Mexico, Brazil, Venezuela, Chile. All these guys are basically resources exporters, natural resource exporters. And many of them are industrial metals exporters. We are talking of guys in Asia like Indonesia, Malaysia, again, resource exporters. One common thing that you will see is that these countries have taken a huge amount of money from IMF as sovereign debt, right? And as the dollar climbs in the run-up to the elections, they're going to have a huge amount of challenge mounting on them to meet their sovereign debt payments. What do these guys sell, Rahul? They sell natural resources.
Yep.
To be able to repay their debt, they're going to flood the market with natural resources.
Yep.
You've got a very crazy situation here. Chinese, the consumption engine of the world, is crippled. Right? On the other hand, you have producers who are saying, we want money to repay our debts, buy our commodities on the cheap. You have a dual pressure on prices, not singular pressure, which is something, in my humble opinion, the market has missed out on completely. The sellers are more eager to sell today as they were as compared to last year, which is what is going to collapse the price.
So the commodity bear market is here to stay.
Rahul, there is this concept in economics which is called pro-cyclicality as opposed to counter-cyclicality. Pro-cyclicality is when asset prices, immaterial of which asset you're talking about, maybe stocks, bonds, currencies, commodities. So where commodity markets are concerned, I've been calling out since many quarters now. I've been screaming that we are going to have a pro-cyclical market. And these pro-cyclical versus counter-cyclical phases last for years at a time. Now, pro-cyclicality is when prices tend to move in the same direction as the real economy is. There is no prize for guessing where the economy is headed. Down. And if I'm betting on pro-cyclicality in the commodity prices, I think commodity prices are also likely to go down. Now, I'm saying this is a hypothesis, of course.
Yeah.
Now, for the commodity prices to rise up, I need hard data saying so-and-so country, which is a major consumer of so-and-so commodity, has started to import more. Unless I see that data, I'm not going to go bullish.
Well, from the data, we can see now that that data point is not going to show up very quickly as yet.
That's true.
It'll take time for that. Okay, so the beauty of commodities is because it's a F&O trade, there's an equal opportunity to go long or to go short. So I think from a trading perspective, there could be some easy money to make here.
Rahul, there's an old Wall Street saying, and I borrow it from my friends, trading profits is the most difficult easy money you'll ever make. So only my wife thinks I live an easy life because I'm sitting in front of a computer and doodling around with a few buttons on my keyboard.
Yeah.
And she thinks she's doing all the hard work in the kitchen and buying vegetables in the veggie market. Making money is never easy, Rahul. But yes, in commodities, I would say that the commodity market is, into inverted commas, more honest as compared to equities, for the simple reason that both supply and demand are dynamic. In equities, your supply, which is the paid-up capital, is static. You only need to stimulate demand. So to that extent, making commodity markets lie, or you hear so many times, operator is active in so-and-so stock. You can't do that to crude oil, natural gas, gold, silver, copper, aluminium, etc. So to that extent, it's less crazy. But unless you know what to do, the market is geared to take away all your money, which you foolishly throw at it. So I think, which is why weekly cash alerts is a pioneering service in its own right.
Yeah, for those of the listeners who are not aware, weekly cash alerts is where Vijay recommends his commodity trade. And Vijay, am I correct? You've not had a single losing trade since September last year?
Oh, the gods of the markets have been extremely kind, Rahul. We started off with a very good show in April. May was mediocre, but believe me, June, July, and August, I have been walking on eggshells. But from September, we've timed the market very well. And I'm also pleased to share with our listeners the news that Weekly Cash Alert is now into net profits.
Wow. In a market like this is great.
Yes, we are into positive returns on equity. And where our bullion physical trade is concerned, we have a huge outperformance as compared to the broader markets. So thank you, Rahul, for giving me the leeway of making recommendations at my own ease and comfort. And it's all been made possible by a wonderful team at Equitymaster.
Thank you. It's been wonderful. I think people love it. We've seen all the feedback. I think if one thing people want to tell you is that they would love to get a few more recommendations from you, but they also, I think, appreciate that you want to be sure, better safe than sorry kind of a situation. So let's talk about bullion. You referred to bullion. You've done very well on bullion, of course. That's a recommendation you made months ago. I think you made silver before you made gold, right? Or was it at the same time?
Yes, I was somewhat tilted slightly higher towards silver as compared to gold, but more or less I've been giving buy calls since June 2019.
Wonderful. Great. So let's talk bullion now. In this context of, again, the coronavirus, there's something called, the concept of the flight to safety. But correct me if I'm wrong, didn't gold fall today? Or I need to check the, latest price, but I thought gold fell today a little bit, which was surprising. I just opened a website called Kitco, which has this data, and it says gold's actually down $20, which is, I guess, relatively significant. What's your take, and what should people be doing with gold and silver?
Rahul, I'll just draw your attention to what I said maybe 5 or 10 minutes ago. What do countries that produce resources do when they have a cash crunch? They sell the resources that are available to them from their earth. Out of the top 10 gold-producing countries, see how many are in trouble. You'll be surprised the Chinese are one of the top 10 gold producers. They're in trouble. The Russians are top 10. South Africa, again top 10. Indonesia, Ghana, all these countries, all of them have huge leverage on their government balance sheets. And the only way they can actually kind of not default on their sovereign commitments, unlike the 1997 Southeast Asian currency crisis or the Mexican peso crisis, where sovereign governments raised up their hands and said, sorry, we don't have the money to pay. That can't happen again. Similarly, the South Africans are now dumping gold. That's what my indication is from my network of friends. Of course, it's not there in the public domain. It's not there in the media. Now, I do admit that there's a little bit of conjecturing too on me and my friends' part. But my hypothesis is that even gold, these countries who are big producers, as and when they need to raise cash, will offer gold in the market. Having said that, I do feel that the demand appetite for gold will be somewhat bigger than the offerings that these countries are making. So temporarily, you will see gold prices easing off, but then gold will get lapped up at lower levels and it will go up, making new highs.
So this is, if I may, it's like the flip case of the market, stock market, where at every higher level you're going to see selling pressure. Here, every lower level you're going to see a lot of buying, buying taking place. So there's a lot of support, you're saying, available to gold, as against in stocks where there's a lot of resistance, to use a technical term which chartists like you use, ahead.
I completely agree, Rahul. I think Equities will get sold into whenever there are rallies, and bullion will get bought into whenever there are deep declines.
Yeah.
Unless there is government pressure against bullion investments, which I'm hearing some noises here and there, not just in India but elsewhere too.
Yeah.
Unless that actually gains traction, I don't think bullion is stopping. We are going to have a good 2021. The reason why I'm saying 2021 and not 2020 is because on 3rd November 2020 you have presidential elections in America. Traditionally, gold is made to go down. I'm being blatant about it. Gold is made to go down so that equity markets in America can go up. I don't think that endeavor will stop this year, irrespective of Corona. So a bigger rally in gold and silver will come in 2021. That's what I'm betting on.
Okay. So gold, okay, we got a perspective on gold and silver, but silver, isn't like, they say silver is like a mixture of, gold and copper. I think that's what they say, right? Where there's a buying for safety as well as that because silver is consumed in manufacturing, it's also linked to economic growth. And if that is not good, don't you think silver will have resistance as well?
Rahul, I partly agree with you, and I will also update you about why I'm bullish on silver. This is something that I have discussed in a video with Rini. Silver is poor man's gold. So anybody who can't afford gold buys a little bit of silver because silver is more affordable to that extent. Secondly, silver has been declared as a electrically critical element. It conducts electricity almost as well as gold. So where your computer CPUs and cores were made of gold earlier, a decade or more ago, gold having become a lot more expensive, now silver is increasingly being used in printed circuit boards, PCBs. I'm coming to the other thing. Every Tom, Dick and Harry is now talking about alternate energy, renewable energy, especially solar. Can you actually make a photovoltaic cell or a solar cell without silver? The answer is no.
That's correct. Yeah.
Now, when solar power was actually discovered in the 1980s, the Germans pioneered it. 1 unit of electricity was produced at $30. Technology has moved on and it's evolved by leaps and bounds. The Chinese, no surprise here, the Chinese are talking about producing a unit of electricity at sub 50 cents, 50 US cents, provided they're given enough silver by millions of tons. And given the opportunity, the Chinese can do it. If there's anybody who can do it in scale and size and within a timeline, the Chinese can. And the world is moving towards electric cars, solar powers, etc., etc. So my guess is silver demand will not back off.
Yeah, that makes sense, because then if it's got a sort of an industry which is going to be consuming a lot for a long period of time, then again it has a flaw, right? There be loss consumption. Okay, so that covers gold and silver for us. I think it's great if you conclude with the currency, because you said that the US dollar, INR, USD INR is the core of your investment thesis. And so you already sort of answered that by saying that you don't say you expect. You're saying if the rupee does not fall to 73, 73 and a half, then it'll cause other problems. But that's, I think, what you're saying should happen. But what's your expectation on the currency? And also for those of the listeners, is there a trade out there?
I think so, Rahul. Even though there is a good trade out there, I would rather let the market do the talking than preemption, because preemption can be a very expensive mistake that traders make. Now, the problem with currency is, or the challenge with currency is, it's traded in 4 decimal points. So unlike Reliance, which is 1,600.10 paise, the USD INR is 71.0025, 4 decimal points. And if you were to mistime the market, your cost of carry will actually, your financial charges will actually exceed your profits. So let the market tell you where it's going and then follow suit rather than leading the market. Don't be a trendsetter, be a trend follower. Having said that, I think what you need to watch out for in the currency space is the April, May, June quarter. This is when your corporate profitability numbers will start coming out. The government will announce its expense and revenue figures, direct tax collections, etc., indirect tax collections, etc. And the USD-INR will suddenly start to discover its own peg or the float. That is when you should basically get clarity. Right now, the markets are heading towards March. That's our financial year end. So a lot of traders will withdraw, industrialists will want to balance their books or reverse their entries, as we call them in India. Banks will call their loans back to basically deleverage the balance sheet of the borrowers, etc. The real trends will start to form in April. So the April, May, June quarter is extremely critical for currency and by default, extremely critical for commodities and equity trades.
Interesting. So there we have it. So if I was to recap, Vijay, and then we can look at a macro view as well from you. Stocks upside, there's resistance, so you're expecting lower peaks going forward. Commodities you spoke of, you gave that brilliant explanation of not just there's a demand issue, but those who are supplying want to supply a lot more because they got dollar debts to pay back. Bullion is the flip of stocks, which is it will have a lot of support at lower levels, but at the higher levels, again, there could be more supply because countries which are in trouble are the main producers of gold. And currency, you're basically saying that wait till April when the real when the real exchange rate sort of identifies itself. But I think in general, you're saying that a weaker rupee is essential to solve the problem, though it will create an additional problem of inflation, which will have to be then tackled differently. So that's sort of the gist of what I got from you. What's your advice to the people who are listening in today on how they should be dealing with this situation today? Not necessarily in terms of trade, but given that you're such a seasoned trader, you've seen 30 years of this. In fact, let me ask you a question before that. What do you correlate the situation with from instances in the past that you've seen over the last 30 years?
I completely agree, Rahul. These are events that occur with almost mechanical frequency. I got married in 1991. And 2 months into my marriage, I got a call almost at around midnight saying, do you know the ex-Prime Minister Rajiv Gandhi is dead? And I almost got a mini heart attack saying, oh, look, the market is finished. The market survived. I was in the Bombay Stock Exchange on the second floor when the bomb blast took place. I thought the market was finished. It survived. I've traded through the Gulf War I, Gulf War II. Market survived. The bombings in 2003 in August in Zaveri Bazaar, not too far from my office. I thought the markets have had it. It survived. So these are events which in the near term might make it look like your house is sinking, but it doesn't. These are challenges, and as long as you can actually set aside some money. The one asset class that I did not talk about today was bonds or fixed income investments. I'm a very big fan of fixed income investments, Rahul, for a simple reason. If my household expense is 1 lakh rupees a month, which I think any average family of 4 living in Mumbai or any other metro city would need to run their house. If at all I was to get 100,000 plus per month as interest or other income from fixed income sources, my confidence level as a trader goes up manifold. Right? So if I have a losing trade where my mark-to-market payment needs to be made and it's the first of the month, I don't have to choose whether I should settle my maidservant's salary or the banyaka bill, grocer's bill, or should I pay my electricity bill or carry over my trade. My subsistence, my survival is taken care of by fixed income. So I can focus on trading and take care of business. So as long as you're insulated from these shocks, and these shocks will come anytime between 5 to 8 years, big shocks. 2008 was a big shock. Are we expecting something like that? Possibly, yes. I'm sure all my listeners must be aware of a gentleman called Satyajit Das.
Yeah.
He is the international authority on derivatives. And he says that the exposure in the derivatives market is a minimum 20 times bigger than what it was in 2008.
Wow.
So if there's going to be unwinding, it's going to be 20 times more vicious. So as long as you're prepared for it, what does Warren Buffett talk about risk? He says risk is not doing something risky. Risk is not knowing what you're doing. So as long as you're prepared for a decline like this, if I'm prepared for a 1,000, 2,000 point decline in the Nifty, I'm not going to lose my sleep in the night if the Nifty actually winds up falling 2,000 points. I start to lose sleep if it surprises me or catches me on the wrong foot. So your asset allocation should invariably be the highest in fixed income. And
enough to cover, enough to ensure that you can get by comfortably, even in case something goes wrong in the markets, which you should expect to happen every few years, you're saying?
Absolutely, Rahul. Absolutely. If your household expense is 100,000 a month, do not trade till you have 100,000 a month coming in from fixed income or other low-risk investment activity, or maybe house rent, commercial property rent, fixed deposits, bonds, etc., whatever.
Yeah, that sounds like a very, very smart strategy, because if you're trying to earn near-term returns from instruments which are designed for the long term, you're bound to get into trouble. On the other hand, if you take care of all your near-term expenses, it just frees your mind up to just focus on the long term and tide over these blips that come every now and then. And I think I'm sure someone's done the research on this, but like I think Warren Buffett said, staying power is very, very important, right? If you were exiting now, you're not cut out for these kind of markets. But if you are, this is the time that you are sort of hunkering down, assuming you've bought the right stocks. That's very critical. And you are sort of doubling down. Again, if you bought the right stocks, then that's when you make the money by, buying when others are fearful and, being fearful when the others are greedy, if you will. And I think the asset allocation that you're suggesting allows you to do that, because then you're free of the pressures of meeting near-term, paying near-term bills, if you will.
Absolutely, Rahul. Ease of mind is what separates a successful trader/investor from a mediocre one, or maybe even a loss-making one.
Yeah. So there we have it. This is the emergency podcast of the Investor Hour. Vijay, any final parting words to our listeners who I don't know what the Dow futures are right now, I've not checked, but who will probably get up tomorrow morning with more mixed news on where the world is headed? Your final words of wisdom for the day.
Rahul, take it from somebody who's been there, seen it and done it all. These are blips on the radar. 3 to 4 months from now, probably it'll just be an event in your life which you're seeing in the rear view mirror. Don't do anything stupid. That's the main thing. Don't sell your deliveries to fund your mark-to-market losses. Don't sell off your family jewels to buy paper kites, so to say. If at all any speculative or trading play is giving you trouble, get out of that. Re-enter it at later levels. Protect your wealth. I think it's very important that my dad, having passed on his wealth to me, my job is to see to it that I pass on something even higher to my son. Right? There should not be depletion. There should be accretion. So year on year, your balance sheet, your personal balance sheet, should show your net worth going up. You can't let it go down just because you're sort of watering the weeds and cutting the roses, as Warren Buffett says.
Yeah. So on that note, on that very, very sort of insightful note, let's call this to a close. Vijay, thank you very much for taking time out. To our listeners, well, like I just checked up, the Dow futures are down again, which means if things remain as they are now, so tomorrow morning you could be greeted by another splash of red in your morning papers or blogs, wherever you get your market dope from. But I think the takeaways are very clear. I think Vijay, as he always does, has cut through all the noise and given us a wonderful, wonderful perspective, laced in both from a trading perspective and from a fundamental perspective, how things could head. And I think the ultimate lesson in everything that we discussed today is be sure at all times your asset allocation is correct, it's right for you, your bills are well taken care of before you are venturing into the markets. Maybe this time you got it wrong, maybe you'll plan better the next time. And on the final note that Vijay said, and which I think is wonderful to end on, is our mission has to be to grow our balance sheet day on day, year on year, so that we can pass on more wealth than what we received. And the way to do that is be sensible in your investments, be sensible in your planning, and hopefully the investor hour will help contribute to that whole process. So with that, thank you very much for listening in, and to better times ahead. Thank you.
Thank you, Rahul. Thank you for having me.
Thank you, Vijay, once again.
Thanks.